You are looking at a loan that has saved over 1 million retirements and quietly taken the house keys from tens of thousands of others. Same product. Same one-page application. Two completely different outcomes. And the three words that decide which one you get are nowhere in the celebrity ads. This is Dorothy. She is 74. She signed the papers. And depending on one phone call she almost did not make, she either keeps her home until her last breath or loses it before her 76th birthday. Both stories are real. This is not a scripted scenario. It is the home equity conversion mortgage, a financial product available to every homeowner over 62, sold by trusted celebrities as a government benefit, but governed by a 300-page rulebook that almost nobody reads. And most borrowers sign long before they learn the one clause that decides which version of Dorothy they become. That clause is not hidden, but it might as well be. Those three words are taxes and insurance. And the clause they live inside is not in the marketing, not in the one-page application, and certainly not in the television spots, where former Senator Fred Thompson looked into the camera and promised you would never have to make a monthly payment again. He was telling the truth about the payment. He left out the part where you still owe the county. You still owe the insurer. And if you miss either, the same government agency that insured your reverse mortgage can start the paperwork to take your house. That is not a loophole. That is the design. To understand why so many smart people walk into this trap, you have to understand what the product was meant to be before the celebrity ads rewrote its reputation. The home equity conversion mortgage was signed into law by President Reagan on February 5, 1988. It was a pilot program, a small piece of the Housing and Community Development Act, aimed at a real problem. Americans were retiring with a house full of equity and a bank account full of nothing. The median senior homeowner had $150,000 in real estate and $14,000 in annual income. The mortgage was paid off or close to it, but property taxes kept climbing. Insurance premiums rose. A new roof cost $12 grand. Retirees who had done everything right were selling the family home just to buy groceries. The heck-heckim was Congress's answer. Borrow against the house to pay for the house. Stay in place. Never write a monthly check to a bank. When you die or move out permanently, the house is sold, the loan is repaid, and any leftover equity goes to your heirs. If the loan balance is larger than the home value, federal mortgage insurance covers the difference. The borrower never owes more than what the house sells for. On paper, it is a near-perfect safety net. And for hundreds of thousands of seniors, it has been exactly that. But the version of the HECM that Dorothy signed in her kitchen is not the pilot program from 1988. It is a product that has been amended, loosened, and marketed by private lenders with a single incentive: close the loan. And here is where the cliff splits. Not between smart and foolish, but between the version of Dorothy who made one phone call and the version who did not. Both women are the same age, same house value, same income. Both signed the exact same documents. The only difference is a single conversation that takes 15 minutes, costs $125, and is required by law. One Dorothy took it seriously. The other nodded along, signed, and never looked back. By the end of this story, you will know exactly which one keeps her home. Let me tell you about Dorothy A. first, because you have never heard about her on the news. Dorothy lives in a split-level house in Columbus, Ohio that she and her husband bought in 1972 for $31,000. He passed in 2015. She is 74. Her Social Security is $2,100 a month, and the house is now worth $310,000. The mortgage was paid off years ago. What she did not have was cash. Her roof was leaking, her property taxes had crept to $4,800 a year, and she had started putting groceries on a credit card. She saw a television ad for a reverse mortgage and almost called the number on the screen. But she asked her son first. He found a HUD-approved counselor who charged $125 and sat with her for 90 minutes. The counselor walked her through what the ads never mention: the origination fee of up to $6,000, the upfront mortgage insurance premium of 2%, which on a $310,000 home equaled $6,200 added to her loan balance on day one. An annual insurance premium of 0.5% that would compound on top of her interest rate forever. And the rule that she still had to pay her own property taxes and homeowner's insurance every year, no matter what. Dorothy A. listened. She did the math, and she chose a line of credit, not a lump sum. She drew exactly what she needed each year to cover the taxes, the insurance, and a few $1,000s for repairs. She never took a dollar more. That was 6 years ago. Her loan balance today is roughly $94,000. Her house is now worth $340,000. She has $246,000 in equity still sitting in her name. She turns 80 this year, and she will stay in that house until she decides otherwise. The reverse mortgage did exactly what it was designed to do. It rescued her retirement. Now, here is the version of the story that nobody films a commercial about. Dorothy B. lives in the same city, same age, same income. Her house was worth $305,000. She saw a different ad with a different celebrity and called the lender directly. The loan officer walked her through the application over the phone in 20 minutes. The counseling session was a formality. She did it over a video call with the television still playing in the background. She answered yes to every question and signed where the arrows pointed. The lender offered her a lump sum payment of $183,000 because it maximized her loan amount and the origination fee that came with it. The loan officer told her she could not be forced out of her home as long as she lived. He did not mention that the loan contract required her to stay current on property taxes, keep the house in good repair, and live there as her primary residence without interruption of more than 12 consecutive months. He did not mention the fine print that said if she failed to pay her taxes, the lender could call the loan in full immediately. She took the money. Within 18 months, the entire lump sum was spent. Not on luxuries. She helped a daughter with debt. She paid off a car. She replaced a furnace. But when the property tax bill arrived for $4,600, she did not have it. She assumed the mortgage company would cover it. The bill sat on her kitchen counter for 6 months. Then a notice of default arrived. Then a foreclosure filing. The amount that triggered the foreclosure was not the $100,000 loan balance. It was $4,600 plus penalties and legal fees, totaling less than $8,000. The lender foreclosed on a $300,000 house, over $8,000 of unpaid taxes. By the time Dorothy B. contacted a legal aid attorney, the sale date was already scheduled. She lost the house and every penny of equity she had built over 42 years. The reverse mortgage did not rescue her retirement. It erased it. And if you think Dorothy B. is an outlier, you need to see the number the Government Accountability Office released after reviewing HUD data from 2014 to 2018. Defaults on reverse mortgages did not hold steady. They did not inch up slowly. They jumped from 2% of loan terminations to 18% in 4 years, not because seniors stopped paying their mortgage. They never had a mortgage payment to make. They defaulted because they could not pay their property taxes and homeowners insurance. The most boring line items in a home budget became the single biggest trigger of senior foreclosures in the federally insured reverse mortgage program. In one case that made it to court, a 90-year-old woman in Florida was foreclosed on because she was 27 cents short on her insurance escrow. 27 cents. The lender filed the paperwork anyway. And when reporters asked why, the answer was not that they had to. It was that the servicing contract allowed it. The system did not care about the arithmetic. It only cared about the checkbox. But the tax and insurance trap is only the second biggest risk Dorothy B. never saw coming. The first is the one that makes her story instructive for anyone who signs with a spouse, because there is a clause in the standard reverse mortgage contract that determines what happens when one of you moves into a nursing home. It does not require death. It does not require a sale. It requires continuous occupancy, and the day you cross 12 consecutive months away from that house, the loan becomes due and payable in full. For Dorothy A., that rule is a legal footnote. For Dorothy B., it was the countdown she never knew had started. Here is how that countdown works, and why it has nothing to do with whether you paid your loan. The reverse mortgage contract says the house must be your principal residence. If you are away for more than 12 consecutive months, regardless of the reason, the lender can declare the loan due. A hospital stay, a rehab center after a fall, an assisted living facility, none of it matters. The clock starts the day you leave. And if the spouse staying in the house is not listed on the mortgage document, that spouse does not get to stay. They get a notice. Pay the full loan balance now, or the house goes to auction. In San Bernardino, a widow received that letter 3 months after her husband died. He was the sole borrower on the reverse mortgage he had taken out 8 years earlier. She had lived in that house with him for 41 years. She knew the loan existed. She did not know her name was never added to it. The letter said she owed $293,000. She had $14,000 in savings. She lost the house. This is not a rare oversight. A study by the Consumer Financial Protection Bureau found that thousands of non-borrowing spouses were unknowingly in this exact position, and many of them only learned it when the knock came. The Department of Housing and Urban Development finally changed the rules in 2021 to allow non-borrowing spouses to remain under certain conditions. But the fix is not retroactive for every loan, and it does not cover a spouse who moved in after the mortgage was signed. The paperwork you fill out in the kitchen determines whether your family keeps the home. And most borrowers never ask the question that would have saved them. They ask, "How much can I get?" They do not ask, "What happens if I leave the house for 3 months?" They do not ask, "What happens if my spouse outlives me?" They do not ask, "What happens if I miss a tax payment?" And the structure of the product pushes them to skip those questions, because the people selling reverse mortgages are not paid based on the customer's safety. They are paid based on the loan amount. The bigger the loan, the higher the origination fee, and the data shows exactly what that incentive produces. Between 2012 and 2018, the percentage of borrowers taking a lump sum payment at closing grew to 70%. The median loan size rose to $135,000. The median income of those borrowers was $26,000 a year, less than half the national median. That number is not a coincidence. It is a signal that the product is being sold hardest to the people with the least margin for error. And the most dangerous form of the loan is also the most aggressively pushed. The lump sum gives the borrower a check and sends them away. It is the easiest to close, the quickest to fund, and twice as likely to default on taxes and insurance than a line of credit. A borrower who draws more than 80% of their loan at closing is 4 times as likely to end up in default as one who draws 40%. The research is public. The pattern is clear. Yet the ads keep running. And those ads have been remarkably successful at keeping the real terms invisible. A national survey funded by the Financial Planning Association asked seniors what they knew about reverse mortgages. The average score on a 13-point knowledge test was 5.91. That is less than 45%. Nearly everyone had heard the commercials. Almost no one understood the contract. You have heard the voices of Tom Selleck, Fred Thompson, Robert Wagner, and Pat Boone, each telling you that a reverse mortgage is a risk-free way to access your home's value. A congressional report later called those ads misleading and noted that they often falsely imply that reverse mortgages are a government benefit, not a loan, and that there is not a risk that seniors will lose their home. The Federal Trade Commission has issued warnings. State attorneys general have filed complaints. Yet the celebrity ads persist because they work. The result is that the typical reverse mortgage borrower today is a 74-year-old widow with a house worth $305,000, a fully paid mortgage, a monthly income just above $2,000, and a knowledge gap so wide that she cannot tell you what happens if she forgets to mail her insurance premium. And her lender is not legally required to check that she knows. The counseling session is mandatory, but it can be completed over the phone in 45 minutes while the television is playing. It can be done with a counselor paid by the lender. It can be summarily nodded through. And when that homeowner signs the stack of paper on her kitchen table, she is not absorbing the clause that will eventually decide her fate. She is picturing the relief of cash in the bank. That is not a moral failure. It is a design flaw. A product built to serve a vulnerable population has been optimized to sell to them instead. But the story does not have to end there, because there is a path through this that works, and it is not complicated. It is just specific. It requires 3 questions, 1 document, and a willingness to treat the reverse mortgage like a tool, not a rescue. The version of Dorothy who kept her home did not get lucky. She got informed, and the checklist she used is the same one that every housing counselor in the country already keeps on their desk. You just have to know it exists. The reverse mortgage is not a villain. It is a tool with a sharp edge, and the Dorothy who kept her house did not get a better product. She got a better question. She asked what happens if I miss a tax payment. She asked what happens if I leave the house for more than a year. She asked whose name is actually on the document, and she refused to sign until she understood every answer. Her story is not about intelligence. It is about process. The same process every housing counselor in the country will give you for $125 and a genuine hour of your attention. If this video helped you see past the celebrity ads and the one-sided pitches, hit subscribe and like. It tells the algorithm that honest breakdowns still matter. And if this kind of content makes sense to you, there is a special offer through the link in the first pinned comment. Thank you for watching,